Hello dear students, welcome to the next lecture of ECON-122, that is microeconomics and macroeconomics. From previous video we have started our second part of this course, that is macroeconomics. Okay, in that we have discussed about the meaning and definition of macroeconomics, then its significances or its nature, that we have discussed in last video. Okay, from in today's video we are going to discuss about the national income. In that we are going to discuss in detail about the meaning and the importance of national income, then circular flow, what is the concept of circular flow, and what are the different concepts of national income accounting, that we are going to cover. So, let us start with the national income. In an economy, goods and services keep on going produced, which needs to be valued, and this we can value with the help of measuring the national income. So, national income is nothing but the aggregate money value. This national income is nothing but the aggregate money value of all goods and services produced in the country during a year. Okay, so this national income is nothing but the all the different products, all the different services, all the different goods which are produced in the economy, and the value of that all produced goods, services, and the different we can say the products, that is nothing but the national income. Okay, so it can also be viewed as a income distributed among the factors of production in the form of rent, wages, interest, and profits. Okay, so here we can measure the national income with the help of income distributed among the factors of production, that is in the form of rent for the labor, for the we can say the land. Okay, then wages for the laborers, then interest instead of using capital, and for the organizations they earn their profits. Okay, so with the help of this income distribution we can calculate the national income also. Okay, so it is also interchangeably used with the national dividend, national output, and national expenditure also. Okay, so next, according to the Alfred Marshall, this national income is defined as the labor and capital of a country acting on its natural resources, producing annually a certain net aggregate of commodities, material and immaterial, including services of all kinds. Okay, so this is definition of national income, which is given by the Alfred Marshall. Okay, he said that as the labor and the capital of country, acting on its natural resources and produces annually the different products, or we can say the net aggregate of commodity, material and non-material products like different services. Okay, so this is national income according to the Alfred Marshall. Then in the words of Irving Fisher, the scientist Irving Fisher, he said that the national dividend or the income consists solely of services as received by ultimate consumers, whether from their material or from their human environment. Okay, so this definition is given by Irving Fisher. Okay, then there is another definition of national income which is given by Simon Kuznets. Okay, so he said that the net output of a commodities and the services flowing during the year from the productive system in hands of the ultimate customers or the consumers. Okay. So, these are the three different definitions which are given by different scientists. Okay. So, you can I think you can understand the meaning of national income. Okay. So, let us move towards the importance or the significance of the national income. Why the national income measurement is important. Okay. So, this national income estimate reveals the overall production performance of the economy, as it seeks to measure the level of production in a particular year. That is why this national income estimation is very important. Then again, the per capita income, which is founded by the dividing the total national income by the population of our country. Okay. So, gives us an idea, this per capita income gives us an idea about the average standard of living of the peoples or the individuals. Okay. So, next one, by comparing the national income estimates over a period of time. Okay. When we are going to compare the national income estimates over the period of time, we can know whether the economy is growing, stagnant or declining. That is why this national income measurement is also important. Then next one, the national income estimate shows the contribution made by the various sectors of the economy, such as agriculture, manufacturing industry, trade, etc. to the national income. So, whatever the different sectors are there in the economy, that is agriculture, manufacturing industry, trade. Okay. So, we can say the contribution of the each and every sector in the economy that can be easily understood with the help of these national income estimates. Okay. Then next important, which is related to the distribution of national income. So, this national income estimates throw light on the distribution of national income among the different categories of income, such as wages, profits, rents, interests. Okay. So, that is why again this national income measurement is important. Okay. Then the national income estimates also contain the figures of consumption, saving, investment in the economy. Okay. Through which we can get the idea of the rate of saving, rate of investment in the economy that determines the rate of economic growth. Okay. Then next importance, with the help of national income estimates of various countries of the world, we can compare the standard of living and the levels of economic welfare of the peoples living in those countries. That is why we have to calculate or the estimate the national income for the different economies or different countries. Okay. Then next one, this national income estimates are valuable guide to economic policy, especially in these days of development planning and active government intervention in the economy. So, here this national income plays a major role to provide a guidance to the development of different economic policies, okay, through which the economic growth can be achieved. Okay. The next important, no development planning is possible without the national income estimates. So, for the developmental planning, these national income estimates are very important. And the last one, preparation of the plans depends very much on the availability of data regarding national income, consumption, saving and the investment, which are all provided by the national income estimates. That is why for the preparation of the plans, these national income estimates are very important. Okay. So, this is about the important or the significance of the national income. The next point, which is related to the circular flow of income. Okay. So, what is the definition for this circular flow of income? The circular flow of income, or we can say the expenditure, refers to the process whereby the national income and the expenditure of an economy flow in a circular manner continuously through time. Okay. So, this income and expenditure, these two aspects are continuously flowing in a economy. Okay. So, there is another definition. The circular flow of income is a way of representing the flow of money between two main groups in a society. That is, two main groups are producers, or we can call it as a firms, and consumers, or the households. Okay. So, this circular flow is nothing but the way of representing the flow of money between these two main groups, that is producer and consumer. Okay. So, here is a difference between real flow and money flow. Okay. So, what is the real flow? This real flow refers to the flow of goods and services, in that the goods are transferred from one factor to another. Okay. So, these are real because they consist of actual goods and services, and when factor services, that is services of land, labor, capital, enterprises, flow from household to firm, which require them for producing the goods and services, this is called as real flows. It means when the factor services means land, labor, capital, enterprises flow from household to firm, this is called as real flow. Okay. Similarly, when goods and services produced by the firm flow from the producing enterprises to the households who buy them for satisfying their wants, these are also called as real flow. Are you getting my point? So, in the real flows, the factors of services, it means land, labor and capital, and enterprises, these factor services when transferred from household to firm, it is called as real flow. And similarly, in case of goods and services which are produced by the different firms that are flow from firm to the household, this is also called as real flow. And these such flows are continuous, and there is no beginning point or ending point of these flows. Okay. So, when we can say here, when in a material form, when these services provided by households to the firms, this is the real flow, and when the goods and services transferred from firms to the household, this is again real flow. Then what about the money flow? This money flow refers to the flow of money. Here important thing is flow of money, and in case of the real flow, these goods and services are transferred from one factor to another. Okay. So, in money flow, this refers to the flow of money in the form of factor payments and consumption expenditure also. Okay. So, the money flow occurs since it is through money that various transactions are conducted, and it is money that facilitates such transactions, bringing flows of money from one sector to another. As we have discussed in case of the real flow, when factor services, where we consider the factor services, that is land, labor, capital and enterprises, that factor services are transferred from household to firm. But in case of the money flow, these factor incomes, that means for the land, the rent is given by the firm to the households. Then for the laborers, wages are given. Then for capital, interest is paid, and for the enterprises, profits are earned. So these flow from firms to the household as rewards for their factor services. So these are called as money flows. Okay, then similarly, when households spend their income on the purchase of goods and services as a result of money flows back to the firms, this also indicates the money flows. Here again, money is transferred from households to the firms when they spend their income on the different goods and services. Okay, so this is the money flow. Then with the help of this diagram, you can easily understand the difference between the real flow and money flow. Okay, so here this one is the real flow diagram, in which the factor services like land, labor, capital and enterprise is transferring from household to firm, and from the firm goods and services are transferred to the households. This is about real flow. Then in case of money flow, the factor services, that is land, labor, is provided to the firms from the household, but for that factor services, the factor payment is given to the households by the firms. That's why this is factor payments. Okay, so with the help of this diagram, you can easily understand what is the flow of, we can say, the cash flow, okay, or what is the circular flow of income. So here we consider two sectors, that is producer or firm and household. Okay, so when these factor services, that is land, labor, capital and enterprises, that is the real flow, is transferring from household to the firm, in that exchange they received the factor payments, that is rent, wages, interest, profit and money. Okay, so it is in the form of money flow. Okay, then when the goods and services are transferred from the firms to the households in the form of real flow, okay, at that time these households made some expenditure or the payments in the exchange of these goods and services to the firms, that is the money flow. Okay, so this is the difference between real flow and money flow, and for the circular flow of income, you can draw this diagram in the examination. Okay, this is the two sector model. Here we consider only two sectors, that is producers or firms and households. Okay, then next point, which is related to the different phases of the circular flow. In that there are three phases, that is production phase, which we can call it as a generation of income, in which income is generated. Then second one is the income phase, in which the income is distributed among the different service factors. Okay, and the last one, the expenditure phase. In that again, the whatever the income is earned, that is going to be disposed for purchasing of any goods and services. Okay, let us see one by one. In the production phase, the production means the creation of utility to satisfy the human wants. Okay, here we are going to produce the different goods and services in the production phase. Okay, so it involves the coordination of all the factors of production in some desired ratio. Okay, and this job is performed by the producer or the firm who takes an initiative with the motive of earning profits. and these firms hire land, labor, capital and organization and makes them payment in the form of rent, wages, interest and profits. And this phase is to produce goods and services, and after selling them it generates income. Okay. So, this first phase in which the production is takes place. Okay. Then second, that is the income phase. The producing firms earn revenue from the sale of goods and services produced by them. So, in the income phase, the firm is going to earn the revenue by selling their goods and services among the household. So, whole of the earning is divided between factors provided by household sectors in the form of rent, wages, interest and profits. Whatever the revenue earned by the selling the goods and services, among that revenue the firm is going to distribute the rents, wages, interest and profits to the household sectors. And such an income is classified into three parts. First one is the compensation of employees, in that the wages, salaries, commissions, bonus are included. Okay. Then the operating surplus, where the profits, rents, interest and royalty is given. And in case of the mixed income, the income of self-employed persons which come under the mixed income, and thus production takes the shape of income of household sectors. Okay. So, this is about the income phase. And the last phase, which is related to the expenditure phase, where the income earned by the factors of production, or we can say the income earned by the household sector, that household sector is going to spend their income on the goods and services produced by producer or the firms. Okay. So, the household sector spends its income to satisfy unlimited and recurring human wants, and any saving out of the total income takes the shape of investment on caption of goods that helps in generating the income of the economy. And this expenditure becomes the income of producing sector that promotes further the uninterrupted flow of income. So, again this income which is earned by the firm from the household sector, which is again utilized to produce new we can say the goods and services. Okay. So, this again this circular flow is continued. Again there is a first production phase is there, then again income phase is there, and again expenditure phase is there. Okay. So, this is all about the circular flow of income. And then the next and last point of this today's topic, that is the concepts of national income accounts. Okay. So, there are few concepts which are very important while measuring the national income. Okay. So, we are going to discuss in detail about these concepts. In that, first one is the GNP, that is gross national product. Okay. So, this GNP, it is the basic social accounting measure of the total production of goods and services in an economy. Okay. So, this GNP is defined as the total market value of all final goods and services produced in the year in a particular economy or in a particular country. Okay. So, this GNP is nothing but the total market value of all final goods and services produced in a year. So, this GNP includes the market value of such products as are produced in agriculture, mines, forest, industries, etc., and the services like transport, communication, banks, lawyers, doctors, teachers, etc., and these are added together during 1 year. Okay. So, the GNP is a measure of the current output of economic activities in a country, and the goods and services produced in the economy are subjected to purchase and sale several times. And that is why, therefore, to avoid the possibility of double counting, GNP includes the market value of final goods only. Okay. In the market, these produced goods and services may be sold number of times. Okay. That is why we are going for the production of final goods, market value of the final goods and services, which ignoring the transactions involving intermediate goods. Okay. So, this is gross national product. Then next concept which is related to the NNP, that is net national product, or we can call it as a national income at a market price. So, in the production of GNP, the capital goods employed are worn out, and the amount of decline in the value of capital goods due to wear and tear, it is called as depreciation. That is why when we are going to estimate the NNP, that is the net national product, the depreciation is deducted from the GNP, that is the gross national product. Okay. So, while producing the goods and services, whatever the capital goods are utilized, that are going to be worn out, and this decline in the value of the capital goods due to the wear and tear, it is called as depreciation, and this depreciation is when deducted from the gross national product, it is called as net national product. Okay. So, the net national product therefore is the market value of all goods after duly accounting for the depreciation, and hence the name national income at the market price. On the other hand, the NNP, that is the net national product, is the net money value of final goods and services produced at the current prices in the year in a country. So, to find out the NNP, there are two formulas. In that, first one is the NNP is equal to GNP minus depreciation, or there is another one formula through which we can calculate the NNP, that is the personal consumption expenditure on the goods and services, that is consumption C, plus the net domestic private investment, that is investment, plus the government expenditure on the goods and services, that is G, plus net exports. Net exports means when we deduct the export from the imports, then we get the net exports. Okay. So, with the help of this formula, that is C plus I plus G plus X minus M, we can calculate the NNP. Okay. So, this is about the NNP. Then next concept which is important in the national income, that is the national income at factor cost, or we can call it as a NNP, that is the net national product at factor cost. Okay. So, this national income at factor cost implies the sum of all incomes earned by the resource suppliers for their contribution of land, labor, capital and entrepreneurial ability, which go into the net production in a year. Okay. But in fact, national income depicts how much it costs the society in terms of resources to produce net output. Hence, it is called as national income at a factor cost. Okay. So, the difference between the national income at factor cost and the NNP at the market price arises due to the indirect costs and the subsidies which pushes the NNP at market prices higher than the NNP at factor costs. And that is why there is a formula to calculate the national income at a factor cost, that is NNP, net national product minus indirect taxes plus subsidies. So, with the help of this formula, we can calculate the national income at factor cost. Okay. So, then the next concept which is related to the personal income of the individual or household. Okay. So, this personal income is the sum of all the incomes actually received by all individuals or the households during a given year. Okay. So, this national income differs from the personal income in the sense that the national income is earned by factors of production. Okay. In when we talking about the social securities, these social securities contributions, the corporate income taxes, then undistributed profits are earned but not received by the individuals. Okay. These social securities contribution, then corporate income taxes, then undistributed profits, these are earned but not received by any individuals. That is why these values are not considered in the estimation of personal income. So, transfer payments like old age pensions, then unemployment doles, then interest on the public loans, etc., are not currently earned but received by the individuals. Okay. Here are two different conditions, that is the social securities contribution, corporate income taxes, undistributed profits, these all are earned but not received by the individuals. But the transfer payments like old age pensions, unemployment doles, then interest on the public loans, these all are not currently earned but received by the individuals. So, to arrive or to calculate the personal income, we have to subtract the social securities contribution, corporate income taxes and undistributed corporate profits from the national income, which are earned but not received and add incomes received but not currently earned. Okay. That is why there is a formula to the to calculate the personal income, that is national income minus social securities contributions, then minus corporate income taxes minus undistributed corporate profits plus transfer payments. It means here we are going to deduct the social securities contribution, then we are going to deduct the corporate income taxes, then we are going to deduct the undistributed profits. Okay. But here we are going to add the transfer payments. Why? Because it is received by individuals. Okay. So, this is about the personal income. Then next concept, I think this one is the last concept in the national income accounts, that is the disposable income. Okay. So, this disposable income, it is nothing but the amount of money available with the private individuals to spend. Okay. So, to arrive at the disposable income, personal taxes, that means the income and personal property taxes are deducted from the personal income. So, this disposable income can be calculated by using the formula, that is, the disposable income is equal to personal income minus personal taxes, which includes the income and personal property taxes. Okay. So, there is another formula is there for the calculation of disposable income, that is consumption expenditure plus savings of the individuals. Okay. So, by this formula we can calculate the disposable income. Okay. So, this is whole about the national income. In today's video we have discussed about the national income, their importance, then what is the circular flow of income, then what are the different concepts which are important in accounting of national income. Okay. So, thank you.